Welcome to the Pharsyde Business Builder. This month we are taking a look at improving cash flow. Unfortunately, due to some technical issues on our side, we could not make 100% certain that we would be able to do this live. So instead, we are doing a pre-recorded webinar that you are probably watching on YouTube right now. During the talk, there are some supporting documents and information and things like that that would have been shared in the chat. Instead, if you have registered for this event and provided your email address, they will be emailed to you afterwards. So I'm going to just go ahead and start the presentation. All right. So those of you who already know me, my name is Tamryn, and I am the founder and CEO of the Pharsyde Group. The reason I have a right to teach you about cash flow is that the Pharsyde Group currently consists of Pharsyde Solutions, which is based in South Africa and the UK, and offers accounting and business development solutions to businesses all over the world. And we also have the Pharsyde Business Builder, which you are watching right now. It is our monthly business club for small business owners in the very early stages of business who need to know more about building a real business as opposed to being self-employed. And then we have Pharsyde Foundations, which is our non-profit organization based in South Africa with a focus of helping the women of South Africa build the foundations of their future. The company is now 16 years old, and it's been a long and hard road here. I went through burnout 3 times on my way, and it was quite a rough ride coming back from that. But the result is that every single service offered by Pharsyde is built around the core value of preventing burnout in other business owners. And one of the greatest sources of stress and burnout in business owners is bad cash flow. There is nothing more stressful than not having enough cash in the bank when you need it. So we're very briefly going to take a look at why healthy cash flow is so important. Worldwide, 21.5% of businesses fail in their first year. 21% fail in the first year, so before they even hit month 12. In South Africa, that number jumps to a rather terrifying 71%. And South Africa is not alone in this. A lot of the developing nations face a very, very similar failure rate for small business. Of those who survive their first year, another 75% will fail before they reach year 5. So in total, more than 80% of businesses will shut their doors before they reach the end of their 5th year in business. So it's important to look at why. Why do so many businesses fail? There are 10 common reasons why businesses fail, but we're focusing on cash flow today. And 2 out of the top 5 failure reasons are related to money. That's battling to access funding, it's poor financial literacy and cash flow management skills. And it is important to note here that one of the reasons business owners fail to get funding, fail to get investment, is because they have poor financial literacy and cash management skills, and therefore they lack the knowledge to build a proper business plan. It also means that the plan they base their entire business on is built around the incorrect financial projections, and therefore it doesn't go as they expect. Other business owners don't know how to price properly. They don't know how to price products or services, and they are way too optimistic about their projected sales and expenses. And 79% of businesses fail because they didn't have the proper cash reserves in place before they started. They believe that they can bootstrap the operation and make sales faster than they were able to. So the thing you should be very sure about right now is that having healthy cash flow is really, really important for the success of your business. And although I have focused primarily on startup statistics here, healthy cash flow is vital for a business no matter how many years it has been around. Pharsyde is 16 years old now, and if we suffer from bad cash flow, we could be closing our doors. Which is why today we are going to look at the top 10 causes of bad cash flow and the ways in which you can prevent them from happening in your business. The first is the most obvious. In order to be in business, you need to be making sales. It is that simple. If you are not selling a product or service, you do not have a business. And in order to fix this particular problem, you would need to focus on your sales and marketing. So you can bring in a marketing agency or a brand specialist in order to ensure you have the right information in front of the right audience, you're giving the right message. And I was going to be putting in the chat a whole bunch of contacts that I have for you that are specialists in this area. So I'm just going to be sharing them after the chat. But if branding or marketing is something that you need assistance with in your business, do connect with these people and see how they can help you. They offer amazing services and they work with people all over the world. Or you might need to be focusing specifically on sales. If you have a sales team, you may need to be reviewing your processes because maybe they aren't as clued up on the benefits of your service as they should be, or you don't have good sales systems in place, so your leads are dropping through the cracks and not being followed up on. Or maybe your sales team themselves are not motivated. And we actually had a wonderful webinar last month on motivation. So I'll share that link in the email as well, because maybe you just need to give your team the right motivation or the right incentives to be selling properly. If you're on your own, you might need to be motivating yourself or working on your own sales systems, because normally a business owner is the face of the business. But we're not necessarily good salespeople. We focus on other parts of our business and we're good at other things. But you can be better at sales if you work on your sales systems. And of course, one of the best ways, simplest and best ways to improve sales, particularly if you are in a service industry, is to network. So I highly recommend a little network called Pomegranate Networking. I will share the link for this as well. You get free access to Pomegranate through the Business Builder, so you can also join us for networking. But Pomegranate is an online international group that meet every Wednesday, and they are very focused on relationship building. It is so worth popping in for a visit. You can visit for free and see what it's like. But networking is most definitely one of the best ways to increase your sales if you are battling in that area. However, bad sales are not normally the problem with your cash flow, especially not in an established business. We think sales is the problem, but normally low profits are our problem. Low profits are far more likely to impact your cash flow than low sales. Business owners tend to put all of their focus on the sales, but it is profit that is more important, because profit is the amount of money you get to keep at the end of the day. And consequently, if your profit margins are too small and your profits are too low, the amount of cash you have available is going to be way, way less than you need it to be. So you really need to be tracking your profit, not your sales, particularly gross profit. That is the amount you make after sales and cost of sales. So it's the amount that you have available to run your business after you've made your sale, after you've paid for your product or whatever it is that it costs you to produce your product, to produce your service. It is the amount of money available to run the business, to keep your business in business. And to fix your profit margins, you need to pay attention to your pricing. Remember in the slides prior, 77% of businesses failed because the business owner didn't know how to price correctly. So you need to be sure you are costing your product or service correctly and then adding enough margin to cover those costs and have money left at the end of the day. You also need to pay attention to how you are spending that money. You need to make sure you are not spending money unnecessarily. Before you purchase anything for your business, check that you need it. You should create a must-have list and a nice-to-have list. And try to only buy the things on the must-have list in order to keep moving your business forward. If you'd like some assistance with improving your profit and with your pricing, you can give us a shout at Pharsyde. We can run a profit diagnostic for you. If you're a Business Builder member, there's a discount code for the profit diagnostic in the special offers section. So do give us a shout. This is an area that we can definitely give you assistance in. But you can also find a lot of information on Google or speak to your current accountant, who will be more than happy to assist you in improving your profit margins. The next reason the next cause of bad cash flow is growing too fast. And ironically, this is one of the main reasons that businesses fail. We all want growth and then we push hard to achieve it. But growth in sales is also accompanied by growth in expenses. If your growth is not carefully planned, you can end up in some very sticky situations. You can outgrow your premises, for example, but you haven't grown big enough to afford a second one or a bigger one. Your service delivery can drop because you've taken on more customers than your current team can actually handle, but you don't have quite enough revenue to hire a new one. You could invest in these premises or this team member because you're expecting the growth, and then something can happen and you don't meet target. And of course, all of this can very badly affect your cash levels. So plan your growth and be disciplined about creating forecasts. You want to guess as accurately as possible how your business is going to change as your sales grow and what you will need to meet those challenges. Now, if you do get more customers, what do you need to serve them? How will you need to prepare for warehouse space or office space? Do you need, if you're going to have to hire a new team member, does that mean you have to get in more furniture? Do you have to get in another computer? You have to think through these things ahead of time and make sure that you have forecasted them into your plan. If you know your numbers, you can plan around them. You can make sure that your growth is disciplined and done according to a set plan. You can even slow growth when you realize you are not yet ready for the next phase. So you could set up a short list for future customers. And actually that works very well in terms of making you seem sought after. It's actually a great marketing tactic anyway to make people wait for something that they want. So slow down your growth. Do it according to a set plan. And that way you can make sure you have put the cash reserves in place to make the plan possible. Another cause of bad cash flow is seasonal variation. Now, I am in the very fortunate position as an accountant that most people require my services monthly. So Pharsyde can work on set retainers and then we know how much is coming in every single month. But most businesses have seasonal highs and lows. You do particularly well in different times of the year. For example, if you're in a holiday accommodation, you're going to do really well during school holidays, and especially well in the December holiday when everybody wants to be at the beach. So while the seasonal highs are amazing, those seasonal lows can be terrifying. And the seasonal highs often come with increased costs, like your growth, because you now need to increase your stock, or you get in temporary staff members, or you suddenly have much higher cleaning bills, whatever the case might be, because you are busier. So planning ahead is your best defense against variational income. You need to know and understand your business's cash cycles. When are your sales high? When are they low? How does this affect your staff, your stock, your operations, and your delivery mechanisms? And how does it affect your cash? Then include your highs and your lows on your cash forecasts and provide for the bad times. Save in the good times in order to cover the low times. Simply looking forward and making a plan ahead of time can save you a huge amount of heartache. Simply accepting the fact that you have seasonal income can make a big difference in your planning and in your business. So plan ahead, which of course leads to the fact that one of the causes of bad cash flow is poor planning. For many businesses, it's simply the lack of disciplined financial planning that is the cause of their cash flow shortages. So if you have a detailed budget, a spending plan, and a forecast, and if you review and update these on a regular basis, you will be streets ahead of most of the other business owners who don't make a plan and aren't ready for the bad times when they come. When you are creating your financial plan, don't forget to put enough money in that plan to cover taxes, annual increases, project renewals, all of those unexpected or things that we don't think about all the time that happen on a regular basis or annual basis. All right? And be careful not to be too optimistic with your sales forecasts. Make sure they are realistic. Know your timelines. Don't project massive jumps in sales unless you have very reasonable data that you can rely on, that you know that those jumps in sales are actually coming. And if you're going to plan well, because the sixth cause of bad cash flow is related, and it's bad budgeting. It doesn't help to have a budget or a plan if the budget is wrong. You need to know that the figures you are working on are correct. You can start by checking the quality of your bookkeeping. Bookkeeping tends to be seen as a bottom level job in the accounting industry. And because of this, we tend to hire low, we pay low salaries to our bookkeepers, and we get in the cheapest one we can because we feel like, we just need to get this done. I personally have no idea why this has happened, why this impression has been formed, because while the mechanics of bookkeeping might not be particularly hard, having a good bookkeeper is priceless. Because if your bookkeeping is done badly, then every single financial decision you make will be wrong. You want to invest in an excellent bookkeeper. Whether you hire or you outsource, make sure you have a very, very good bookkeeper and that you can be 100% confident that those accounting figures are correct. Because you need to trust your financial reports. You want to use these reports to create your budgets. And you can only do that if you know they contain accurate information. Also, like I said previously, make sure that you have borne in mind your seasonal variations, your seasonal and annual variations, and you've made provisions for the unexpected. So don't just look at your historical figures, Use the historical figures to guess the future. Include your increases, your changes in projects, your seasonal variations, the fact that your costs might go up at particular times of the year. For example, insurances normally go up around September, which, whereas other things might go up in March. So you need to bear those things in mind when you are creating your budgets. Then you need to review your budget and make sure that your expenses aren't higher than they actually need to be. So you need to review what you're spending on, as well as making sure that you've got an accurate historical set of information. This cause of cash flow is probably the most common, and it has the most devastating impact, which is bad payment collections. You can have a phenomenal sales team. You could be smashing your targets and reaching sales figures of your wildest dreams. But if your customers are not actually paying you, it means nothing. That money has to land in your bank account in order for your cash flow to be healthy. 77% of SME owners report a negative impact from their customers not paying their bills on time. 35% of them said that late payment has a negative effect on their personal finances as well as their business finances. 40% of business owners don't chase late payments because they're worried it's going to damage the client relationship. And 26% don't chase because they just don't have the time to chase. And the good news is it's probably the simplest cash flow problem to solve, because all you need to do is start chasing. In most cases, a single reminder email or phone call is all it takes. Most people pay late because they have forgotten, not because they are dodging you. So a simple reminder will get people to pay. Have a system for sending friendly reminders before the due date and after the due date to very nicely keep your bill in your client's mind so that they pay you on time. Also, review your processes, starting with your quoting process. Are you actually negotiating your terms in advance? Are you telling your client when you expect payment and how your payment works? Do you get signed contracts? Do you get purchase orders proving the purchase? Do you bill at the right times on your project timeline? Are you disciplined about sending the invoice out when you are supposed to in order to get the money in when you need it? And do you make sure your invoices have the necessary information, the supporting documents? And then, of course, do you send reminders? Review your processes of how you quote, how you invoice, and how you collect. Because it might simply be that you don't have steps laid out for these things. And so you forget important pieces, and that's why your clients are paying you late. A good collection process results in less than 5% of your customer book not paying you. But some will still not pay. So make sure you include a plan for your bad payers. Know ahead of time what you are going to do if someone doesn't pay you. Do you add interest? Are you going to send a lawyer's letter? Are you going to actually hand them over to debt collectors? Plan it ahead of time and the timelines involved. How much time are you going to give each client before you add interest, before you send the letter, before you hand them over? Plan it out so that you can automatically follow this process when you need to. You don't have to suddenly do it in the middle of a bad day or a busy day when you realize that you don't have the payment in the bank that you should have. You can have this automated process that you know what to do at every step, right from quoting all the way to collection. The eighth cause of bad cash flow is bad inventory management. Now, managing stock levels incorrectly can be very costly. It doesn't seem that way, but having too much stock on hand means you've put too much cash on items that you haven't sold. So that money's sitting on shelves instead of in your bank account. And you run the risk of that stock becoming stale or damaged or obsolete. On the other hand, if you have too little stock, it can mean losing out on a sale or disappointing a customer. So you need to have a strategic approach to inventory management based on actual and accurate financial data. Find an accountant who is experienced in stock management and get a proper stock system. Please do not use Excel to track your stock. Invest in stock management software. But the software you use is only part of your system. You will also need a management system in place so you can do things like monitor inventory levels, make sure your physical stock takes are happening, make sure that you account for how the stock has been used. So is it being sold? Is it broken, stolen, obsolete? You need to have systems in place so that you know what is going on with your stock levels and what happened to the stock that is not there. As I said, work with an accountant who has experience in this area. It is a very important area to get right. Pharsyde does not work with stock, so we can't help you, but we can recommend people. So if you don't have an accountant who works with stock, give us a shout anyway, and we will put you in touch with someone who can look after you. And like carrying too much stock is bad for your cash flow, so is carrying too much debt. Carrying debt can be extremely detrimental to your business and your cash flow and your mental health. Be very careful about taking on any debt in your business. Make sure that the debt is working for you, not against you. In other words, it must be the reason for the debt must be producing more income in your business than the debt is costing you. So you're going to use financing, for example, to buy an asset. That asset needs to be producing more income than the loan is costing you. Otherwise, it's not working for you. It is working against you. If you need to take funding, if you need investment, you need capital in order to grow, in order to survive a couple of months, then make sure you do a very, very careful assessment of the fund to ensure that it is the correct solution for you and your business. Funding options for business are continually evolving, and what worked for you as a startup might not work in the expansion or maturity stage. So you need to do your research before you just take on funding, and definitely do your research before you take on a debt or financing loan. You need to make sure you have properly calculated the costs involved and that you have correctly forecasted your repayments and your interest in your planning before you take that decision. If you are in debt, personally or in business, and you are battling to break free, I highly recommend a masterclass by the wealth chef, Ann Wilson. She has a masterclass on how to break free from debt, and I will share the link with you. Personally, I recommend avoiding debt as much as possible. I know that there are very clever ways to leverage debt, but for small business owners who are trying to build a business and manage their personal finance as well, debt seldom works out. It is, however, very tempting to apply for loans, especially when you're faced with bad cash flow. and especially when you're faced with the 10th cause of bad cash flow, which is insufficient reserves. I gave you stats for business failure at the beginning of this talk, and of those businesses that fail in the first 5 years, 33% simply ran out of money. You are in particular danger of this happening if your income is seasonal. And this is scary as a business owner. We are all terrified of running out of money. Please do not let this fear drive you into debt. All right. The first thing you should be doing is not overestimating your future sales when you plan ahead. All right. Make sure you have accurately forecasted and preferably under forecast so that you're preparing for the worst. And plan ahead for big expenses. And have a savings account to make provision. It is far cheaper, far safer, and way better for your business to get through the bad times using your own money that you saved in the good times than to borrow someone else's and pay interest on it. Okay, so those are the top 10 causes on bad cash flow and some tips on how to prevent them. But trying to work on all of them at the same time is simply going to be overwhelming. All right, and if your cash flow is bad, and you are currently working yourself too hard in an attempt to increase your sales because your cash flow is bad, that means you are probably already overworked and overwhelmed. So instead of saving my slides, which I will share, and working through every single one, I want you to focus on 5 things. 5 things that are easy to implement and will help you. We're going to start with increasing your profit instead of your sales. There are 9 drivers of profit in a business, but I'm only going to focus on 3 today, the 3 that make up the sales equation. So sales in your business are calculated very simply by taking the number of people who bought from you, the average price of your product, and the number of times they bought it. That is the sales equation. That is how you get the number of sales in your business. The 3 drivers here are customer numbers, price, and sales per customer. Increasing any one of these drivers will help you improve your sales. So if you are battling with sales, have a look at these 3 and see how to increase them. But most business owners focus on the number of customers and they miss out on the 2 that actually increase profit, which is the price and the sale per customer. So working on those 2 profit drivers will dramatically improve how much money you make without you having to work harder for the money. So first and foremost, do not undercut yourself to compete. You need to make sure you are charging your full value. Do not discount yourself to compete with anybody else. Instead of trying to win a job on price, make sure you have created a product or a service that people will pay anything to have. You do yourself, your industry, and your client a disservice when you discount. Because discounting might get you more customers, but it never makes you more money. You have a lower profit and more work, and you're not going to properly serve the clients that you have. So rather have fewer clients at a higher price and provide a world-class service that they are happy to pay for. Which leads to the profit driver of customer numbers. Okay. But instead of seeking more, My advice is get rid of your nightmare clients. These are the clients that expect discounts and then demand the earth from you. And 9 times out of 10, they're going to pay late or not pay at all. And I know it feels counterintuitive to cut clients when you're trying to make more money. When your cash flow is bad, the last thing you should be doing, or you feel like you should be doing, is saying no to more sales. But I'm going to prove to you, using numbers, because that's my strength, that it is a good move. So let us look at a 5-hour job that you normally sell for 10,000. All right. A nightmare client is going to ask for a discount. So you're not going to make your 10, you're going to get 8. They're then going to turn your 5-hour job into a 20-hour job because they're going to nitpick and change and move the goalposts and then complain and then ask for a redo. And next thing you know, you have spent 4 times the time that you should have on this simple job. And then they're going to pay you 30 days late. So the end result is that you get 8,000 for a 5-hour job that you spent 20 hours on and then waited 30 days to get paid. By contrast, your good clients will pay you in full and only take up 5 hours. So 20 hours means you get 4 jobs done. They will then give you 5-star reviews and get you more future clients, and they will pay on time. So in the same amount of time, good clients will earn you 40,000 and bad clients will earn you 8 and affect your mental health. So obviously, you would rather be working with a better quality client than saying yes to the wrong person. So I encourage you to go through your client list and first of all, cut your toxic clients. And secondly, define your ideal client and focus on serving your high quality clients instead. Then you can focus on the third profit driver, the purchase by customer, and sell more to the good clients that you already have. Good clients that are happy will happily buy more from you. So find ways to upsell your services or add to your products so that existing clients that you trust and are happy with will come back, spend more, and who will pay you on time. The second way to improve cash flow is to track it. Track your cash. And I know this sounds obvious, but there is actually a big difference between accounting profit that we've been talking about so far and actual cash in the bank. That tip we just went through, it'll improve your profit. If you work on those 3 profit drivers, your profit will increase. But like I said earlier, that only matters if the customers pay you. But payments aren't the only thing that determine what is sitting in your bank account. So it is vital that you don't just do normal accounting and make decisions off your income statement. You need to be tracking your actual payments. So you might also have money in your bank account that belongs to other people. So customers might have paid you and there's money sitting there, but you might have received a loan that needs to be repaid. Or you might have to pay salaries and taxes soon. And then there are the big expenses that don't appear on the income statement at all. Things like asset purchases or dividend payments. So cash and profit are not the same thing. And there is often a discrepancy between your invoice date and the date you are paid. So you can issue an invoice to a client today, but they might only have to pay you in 30 or 60 days' time. And the same applies with suppliers. I might have bought something today, but I might only have to pay them in 2 weeks. So you need to track your expected payments from customers and your expected payments to suppliers in order to get a realistic idea of how your bank balance is going to look in the future. And then you must please plan for the big expenses, things like debit orders, salary payments, taxes. You should forecast a minimum of 3 months in the future so you can see the dips in your cash before they happen and you can plan accordingly. And if possible, as I say here, invest in proper cash management software. There is nothing wrong with using pen and paper, and Excel is excellent. It is better than not planning at all, and it works. It is a very powerful tool when used for cash flow management. But Excel still has a lot of room for human error. So if you can, use software that integrates with your accounting software and it will import and give you accurate answers, it is much, much better. We recommend these three. I will share the links for you in that email. But the Float app, Fathom, and Sift have amazing cash flow forecasting tools in them that you can use to plan ahead 3, 6, or 12 months with far more accuracy than you can do on paper or in Excel. So we do highly recommend these. But whatever you are using, start to track your cash, not just your sales, not just your profit. How much cash you are expecting to have in the bank at any point in time. Tip number 3 is the most important. As I said earlier, one of the biggest causes of bad cash flow is bad payments. It's also one of the easiest to fix. All right, so like we said, neither sales nor profit equals cash in the bank. You need to make sure people are paying you. And payment collections is one of the most important but least applied of basic business principles. And all you really have to do is improve your payment collection system. Where possible, take money up front. Now, if you can't charge a full fee up front, see if you can take a deposit. This is especially important if you have to buy raw materials or pay a contractor in order to get a job done. Take a big enough deposit to cover those costs. There is nothing wrong with asking for upfront payments. A lot of people do it. You can, even if you want to, I know I said don't discount your prices, but you can have much higher prices for people who don't pay upfront and do a slightly lower price for people who are prepared to pay upfront. That will encourage upfront payment. If you have recurring fees, get a debit order system. I will share information with you about a wonderful system called 3 Peaks. It is cheap to use, easy to implement, and extremely efficient. But there are lots of options out there. If you receive payments that are recurring, they are the same every single month, then please set up a debit order system. Do not give your clients the chance to pay you late. Just make it mandatory to pay by debit order. If you don't have recurring fees, then one of the easiest ways to get payment is to make it easy. So make sure you have multiple payment options. Use something like a payment gateway and allow EFT, credit card, debit card, anything that customers can pay at the simple click of a button. The easier it is to make the payment, the more likely that the payment is going to happen. If you can, integrate that with your reminder system as well, so that when you remind them to pay, they can also just click the button to make the payment. And lastly, a well thought out planned collection system will change your life. Knowing ahead of time and having in place a series of reminders and warnings via email, SMS, or phone call. We all hate chasing people for money. But the truth is that your clients are as busy as you are. So even with the best intentions, if you do not place yourself in their thoughts, they might forget you. A system of reminders and warnings will vastly increase the likelihood of you receiving payments. You can use collection software, or you can have a manual system. Just have reminders in your own time management, in your own schedule that you have to send them. It doesn't matter if you do it manually, just have a system. We highly recommend a software called Nagging Panda, not just because it automates the collections for you, but because, as you can see on the right here, the pandas are really cute. So it is a very friendly way to remind people to pay you, and it is an excellent system that works extremely well. So we will share the details with you for that as well. But as I said, whether you have an automated system or you're doing it yourself, just make sure you send those reminders, send those warnings, let people know, hey, your payment is coming up in 5 days, or oops, your payment was supposed to be made 2 days ago. It makes a big difference. And for those difficult clients, you can start with, I'm really sorry, but your payment was due 10 days ago. We are forced to start adding interest at this point. Or payment was due 30 days ago. If it's not paid within 10 days, we will be handing you over for collection. So your reminders, your warnings, they can go from really, really friendly to really, really unfriendly. And it's all systemized so you know when to send which one. The most obvious way to control your cash flow is to control your expenses. Our current economic climate is a very uncertain and changeable one. So your costs are constantly fluctuating. There is huge uncertainty surrounding markets and economics at the moment, no matter where you are in the world. So keep an eye on your accounting. You want to keep an eye on your income statement and make sure you are paying attention to unexpected fluctuations. A sudden jump or drop in an expense is something to pay attention to and make a plan to fix. You can control expenses by communicating with your suppliers. The better your relationship, the more likely that you can negotiate better pricing or better terms. And when it comes to things like insurance, you don't actually have to accept your annual increase. You can negotiate it down. So make sure you stay in contact with your suppliers, build a relationship with them, keep an eye on your market, and if necessary, switch suppliers to keep your costs down, if that's what you need to do. However, I will add a caveat there. You should never be selecting a service by price alone. You need to balance price and value. We spoke about value earlier. You should be charging your full value. So you should understand that you get what you pay for. So don't just fight a supplier to reduce the price. Make sure that you are getting what you need for a good price, not the lowest price. And the third way that you can reduce expenses is to investigate automation. Automation software 9 times out of 10 will cost you less than people, and it will improve efficiencies, which means you can get more done for the same or lower cost. So if you want to review expenses and keep your expenses low, then remember you need to be keeping an eye on your accounting, looking for unexpected changes, negotiating and staying in contact with suppliers and making sure you're getting full value for what you are paying, and then consider automation, especially at the moment. There is a huge spike in AI software. Do investigate it, but also do be careful because it's new and sometimes it's not as clever as it appears to be. So make sure it is doing what you need it to do at a price that you are willing to pay. And the fifth way that you can improve your cash flow is to expect the worst. Murphy's Law states that anything that can go wrong will go wrong. And when things go wrong, they cost you money. So when doing your projections, halve your income and double your expenses. Expect customers to pay you late and plan for the unexpected. Set up extra bank accounts and make provision for your taxes. Things like VAT and income tax, PAYE, anything that you know you have to pay can be planned for during the month as income comes into your bank account. As your customers pay you, take a portion of each payment and pop it into the tax provision account so you can easily pay the taxman when the time arises. Use one of your provision accounts to plan ahead for your big annual fees. Things like membership fees or software subscriptions or annual insurance payments. If you divide those big amounts by 12 and put that smaller amount in a provision account every month, it makes it a hell of a lot easier to pay them once a year. And make sure that you have savings. Save something every month. If you can only set aside a tiny amount, set it aside. Create a buffer for the unexpected. You will find it much, much easier to keep your cash flow healthy if you have separate provisions for these things. Okay, so I don't have a summary slide here, but I will just quickly summarize for you 5 things that you can do to improve your cash flow today. Start tracking your cash, forecasting your cash in the bank, not just your accounting profit, but how much cash you expect to have in the bank at any specific time in the year. Forecast your cash. Secondly, control your payment collections. Put a proper system in place to remind customers to pay you. Preferably get them to pay you upfront. But if you can't do that, have a good collection system. Remember your profit drivers. In order to have more cash, you need more profit. So make sure you are charging your worth. Do not undercut yourself. Do not undervalue yourself. And make sure you are upselling to good clients and not hurting your mental health and your business health by serving toxic clients. Control your expenses. Cut them as much as you can without it being harmful to your business. Make sure you are working with the right suppliers. Same way that we review customers and look for ideal customers instead of toxic ones, you should be doing the same thing with your suppliers. Even if they are more expensive, if they are providing a better service, they are the ones to work with. And lastly, expect the worst. Never overestimate sales. Never be too positive when you are doing a forecast. If you plan for the worst, then when the good things happen, you're just in a better position than you were expecting to be. Pharsyde can help you with a number of things. We do have a cash flow improvement service which will work you through the 10 causes of bad cash flow and help you improve them. We also can help you set up the collection software in Agni Panda. We do a profitability enhancement service, a performance management systems development, a whole bunch of things that will improve your business performance and the cash in the bank. If you would like to get hold of us, here are the details. But also, please don't hesitate to give me a shout. if you have watched this recording and you have any questions. It was quite a fast recording. If I don't have a chat box to respond to, then I kind of fly through the material. So if you have specific questions regarding any of these points, please send them through. Be more than happy to help you out on email and make sure that your your cash flow is healthy in your business. Thank you for taking the time to watch. And if you have provided your email address to us, we will be sending you the supporting documents, all the things that I referred to during this recording.